What are the 4 money myths putting your financial future at risk? Find out more in this episode. All right, in this episode, we're going to be talking about the 4 money myths and how these myths may be putting your financial future at risk, because the traditional advice we've all learned and had over the years may not necessarily be true, because it's usually rigged for the institutions and banks and not necessarily you. And the first money myth we're going to talk about is the myth about investing versus saving. The myth is in investing is that you have to invest to grow your money. The truth is that when you invest your money, you are taking on risk and you could lose every penny of your money. So how many of us want to lose our money? If you can accept the risk and take that risk and accept losing it, that's great, but most people don't want to lose that money and aren't willing and aren't able to lose that money. But why save? Because it doesn't grow your money. So the myth is you can't really grow your money when you save. It doesn't give you enough interest. The truth on that is saving is capital preservation, so it's more about return of your capital. And there's lots of financial products out there that give you very, very good returns to actually have a savings vehicle that you know you can count on, no matter what happens in uncertain environments. The repercussion of buying into this myth is that you always have to take on volatility and risk, because you've learned that investing is the only way to grow your money, is that you could not have any money for your future, because you put it all into uncertain environments instead of into secure, guaranteed savings vehicles for your future. So to recap on myth number 1, saving versus investing, it's important to understand that there are vehicles out there where saving is a part of your financial future, and you don't necessarily have to think about taking on the risk and volatility to grow your money. Myth number 2 is average rate of return versus magnitude of return, and what I was brainwashed on was the magnitude of return, which means that the day you need your money is where all the growth will be or all the return will be. But in reality, it's the order return that matters. It's like if you invested $100,000 and then in year 1 it grew to $200,000, that's 100% return. And then the next year it came down to $100,000, that's a reduction of 50%. And then on the next year it went up another 100, so we're back to 200, up to 200 again. And then that would be another 100% return. And then on the 4th and final year of this investment, it dropped back down to 100, so that's a 50% loss. The average rate of return in those 4 years was 25%. But what did we make in those 4 years? Well, we didn't make anything, 0. So that's what I mean about order return versus magnitude of return. So in summary, focus on the order in terms of making sure you have investments or savings vehicles that are going to create money for your future and not have to rely on that magnitude. Number 3 is protection versus no protection, or feeling that you're indestructible and don't need coverage because you have other assets or other liquid cash that would help if situations such as disability, critical illness, or even death occur. And the myth really is that there's times where you do need those types of vehicles in place, because you may not be able to provide the money for the family from your assets because of the erosion on the tax, and the preservation of your estate are no longer there because there's no life insurance, or everything gets tied up in probate and the family can't get access to your dollars, right, because of that situation. So that's a summary on that myth, is that you do need protection. You do need life insurance, whether you're young or old. You do need to have proper disability and critical illness and those protective plans in place for your future on that myth. And finally, myth number 4, accumulation versus distribution. Accumulation means that you're going up this mountain like Everest and you're building up this big savings for your future, and then at the end you've built all this money, so now you're at the top of the mountain. How does it feel? It feels pretty good, right, on that climb up that Everest? Now you're focusing on coming down the mountain. Well, do you have a plan to come down the mountain? Just as important as going up in terms of having the guides and the equipment, all the things you need, 67% of accidents on Everest actually are on the descent. So this analogy is now looking at, okay, we're on the distribution of coming down, meaning we will have money for retirement and we don't want to outlive our money. But in reality, a lot of times taxes and inflation and uncertain vehicles, meaning investments, are going to erode down, which means you fall off the mountain because now you don't have enough money to live into your 70s, 80s, or even 90s, or even past into 100. So that myth, in summary, is not just focusing on accumulation, but focusing on making sure you have enough money for the distribution or coming down that mountain to know that you never run out of money, no matter how old you are. So that's myth number 4. These 4 money myths are 4 myths that our clients, and even myself for that matter, had in our lives because of the traditional advice we received in the banks and financial institutions that have talked to us about these myths that really aren't true. If you've fallen for one of these myths before, hey, I'd love to talk to you more about this, please click the link below to set up a free 30-minute consult with me. When you do, I'll help you create the solutions you need to create financial control for life.